Okay. All right. So here's the deal. In Elms for today, if you go to the Files tab and you go to the CAT model folder, I put up a file called Valuation Model CAT 2016 Part 2 Video.xlsx. All right. So if you completed homework 7 and you matched everything we did in class on Wednesday, that's the same file. Okay, so you're welcome to use what you had submitted for homework 7. If you had trouble with homework 7 and were not able to submit it, and you want to follow along with what we do in class today, that's the file that we ended up last Wednesday with that we're going to start with today. Okay, so I'm kind of giving you the opportunity to use a file that matches the video of where we were last week. Okay, so I'm going to start with that file as a premise. So let me open up Excel. And that is the Part 2 video. All right, so the next thing that we are going to do is I'm going to rename this file, save as, UMD 443 Spring Model. I'm going to rename this file the baseline file, baseline, and I'm just going to add to it video after it because this is the one that's tied to the video that we're recording. All right. Now, the word baseline is kind of meaningless outside of this class. It's just language that I am going to use. So if you talk about this with other people, they'll look at you like you're crazy, right? But the idea of the baseline file is in order to do the valuation, we need to make sure that we have the most current data in our model so we're ready to begin the valuation process. So the baseline model is the process to put the most recent data for the company into our model file. Right? So what does that mean? Well, let's go back. If you look at the data tab that's in the model that we were working on last week, if we're going to do the valuation today, which is March 28th, then we need to make sure that we have the most recent data, because Bloomberg is updating all the time, for CAT. Okay? So here's what we're going to do. We're going to go to Bloomberg. We're going to go to CAT. We're going to go to the FA tab. We're going to go to the model that you created under the custom. And we're going to export this current template to Excel. Now, some of you had some challenges, which I got emails for late last night over the weekend, with this part of the process where you'd export to Excel, and instead of numbers, it would give you errors, and it would say like pound name. Right? So if you run into that problem, let me explain to you why. If you look at the version of Excel on these computers, there is a Bloomberg add-in. Okay? So it's a plug-in module that Bloomberg has created that has to be installed in Excel. This Bloomberg add-in, basically when you dump it from Excel, is what allows Excel to interface with the Bloomberg database over their APIs to basically get this data. Without the Bloomberg plugin, when you open the file, Bloomberg can't send the data without the plugin. So here's the thing. The computers in this lab, right, unfortunately are built on a University of Maryland image. So in the University of Maryland image for Excel, this plugin does not exist because nobody else is using Bloomberg. Right? So basically, Bloomberg plugin has to be manually installed on all the computers in this lab. Now, from time to time, for security and other reasons, these machines are reimaged constantly. When they are reimaged, the Bloomberg plugin is gone because the default version of Excel is then reinstalled in these machines, and therefore, when you export, then you'll get the error that it can't find the data. So two options. Option one, go to a different terminal, right, that has the plugin that hasn't been reimaged. Or option two, you have to reinstall the plugin. So what that involves in Windows, now this is Windows 10, these machines have older versions of Windows, but if you go to the Start menu, and there's a folder on every one of these machines called Bloomberg, there's a file called Install Office Add-in. You just run and install that file. And what that will do is it will put the Bloomberg menu and plugin into Excel. Right? And so that will fix the export problem. Now, here's the thing. What it involves is install the plugin, then you must completely quit out of Excel and completely quit out of Bloomberg and then reopen them both in order for the plugin to basically fully work. So install the plugin, quit out of the software, install the plugin, reopen the software, should work. Okay? So that's what has to be done. Now, for purposes of today, I am taking this file that I just exported and I have put it into Elms in the cat folder, and it's called cat data. All right, so that's the file that I exported during the 11 a.m. class this morning, and I uploaded it. So if you're following along, you're able to follow this process. Now, here's the other thing. When you export this data file, all right, you'll notice that there's these dashes. Okay, and these dashes are basically fields that Bloomberg doesn't have any data for in the database, so they might as well be zeros, except they don't call them zeros, they export them as dashes. Well, that's a problem because in formulas with Excel, a dash kills the formula. Right? So if we put this data into our model and a cell reference has a dash in it, the model will not work. It'll give you an error. You have errors throughout the whole model. So dashes have to be turned to zeros. All right? So the easiest way to do this is to use Control F. Oh, sorry. What the hell? All right. I'm having some Excel problems today. Hit Control F, which is find. Then there's a second tab that comes up, which is replace. And then basically put in the dash. You can copy and paste the dash. Replace with 0, replace all. Okay, so it will replace all of the dashes with zeros. And I apologize for those of you watching the video that Excel just sucks. All right, so here's the thing. Excel for Mac. Microsoft really needs to work on this. So Control F, find, replace, and one way to do this is just copy. You can paste it right in here. Replace with 0, replace all. And you'll see there were 28 replacements. Save that file. Okay, this is something that's required every time you export from Bloomberg because it will always give you the dashes. And dashes will choke our valuation model. So I then save this file to my downloads folder. So I'm going to go to the one, so I'm having some Excel problems. I'm going to go to the one that I'd saved earlier, which is basically this file, valuation model cat data. Okay, and that's also the one that's on Elms. And so here's the next piece. You go to our valuation model. This is the one, the baseline file. The first tab is called Model Data tab. It's basically just this. So what I want to do is I want to take the exported data from Bloomberg, select the whole tab, copy it, go to our new valuation model, the Model Data tab, select the whole tab, right-click, paste special, values. Now, you don't want to copy and paste. You want to copy, paste special values. Here's why, then hit OK. Here's why. If you copy and paste, what will happen is Microsoft will make a link to the other file. So that every time you open this Excel, it'll say, where's the other Excel file you copied from? All right, so to prevent that from happening, just copy the values, the numbers, and put them in your spreadsheet. Don't copy paste between spreadsheets, because sometimes Microsoft will create links to that original spreadsheet, and you'll never be able to break that link, and it just gets really annoying. So when you copy, right-click on the menu, paste special. And then you have different options, paste special values. That's the one you want after you copy the spreadsheet. So here's the point. To make sure that your paste didn't screw up our model, right, go to the CFI tab. That'll be your check. Two things. One, make sure there's no errors. Because, for example, if we forgot to put in the zeros, you'll start to see errors on the CFI tab. So if you don't see errors in the CFI tab, that's one of two good things. And here's the second thing. Make sure your CFI balances. right? Because if your CFI balances, you probably have a clean import, right? If your CFI does not balance, then you have a problem, right? And here's where the problem could occur, and I alluded to this in the last assignment. If you go back to the Model Data tab, what probably will cause the CFI to not balance is that one of the items on this list could be missing. And then what we would have to do is figure out what is missing, add it to this list, and then sync it through the entire model. Now, I am 90+% certain that for the companies that you have chosen, you will not run into that, right? But this is what I was referring to last week when Bloomberg changed everything, that we have to make sure that we account for everything, and that's the problem, is that sometimes the accountants will create this new gap category that they'll report, and if they throw it out there and Bloomberg picks it up, we have to account for that category in our model, and if it's not already in one of the existing categories we're accounting for, the model won't balance. And that's why CFI is the tab to check this, because you can't get a balancing CFI or the other economic statements unless every line item in the income statement and balance sheet has been accounted for. So that's why this is a good quick check. And I did this with the CAT model, and it seems to be working, so we're okay. All right? So this is what I mean by baseline. Now, here's the other piece of the baseline. There were two tabs where we do the valuation and change things, and these are the tabs. So the first is the last reported year. Well, for CAT, the last reported year was 2015, so make sure that the last reported year is the last reported year for your company. Now, it could be some companies have a fiscal year which ends in March, and starting in April, they actually could be on 2016 fiscal year. So even though it's 2015, we put 2016 in the model year. All right? Then we'd have to change the WACC, because the WACC is going to change daily. So our valuation is going to be as of March 28th, so we need the March 28th WACC. Well, if you go back to Bloomberg, type in WACC, and hit enter, you get a current WACC. And right now it's 6.4%. All right, so up here you can take a screenshot. You can take capture screen, save file. And I did. My computer's having some slowness with exporting right now. But I saved the screenshot of this WACC screen. So you have a template for what to do. And by the way, I put the 3 screenshots we're going to need into the CAT folder on ELMS. Matter of fact, I put them in here as of March 28th, so you know those were today's. And I took out the historical screenshots so you don't accidentally use the wrong screenshot. But this is the template for what 3 Bloomberg screens you will need to update your model for a new baseline for a new company. All right, so 6.4%. The second screenshot that you will need, or screen in Bloomberg, is for shares outstanding. You'll get that off the description or DES short screen, and we'll use the current shares outstanding for CAT. Right? So again, I took a screenshot, I put it up there. Right now, 582.3. I think we'd actually used this last week, and it hasn't changed in the last 7 days. Okay, so 582.3. Now, the other thing that's going to have to change here is on the ratios. And what we're trying to do with our baseline, let's go ahead and save this, is we're trying to get to the first valuation, which is called the as-is valuation. Right? So right now, the share price of CAT is $75.28. Bouncing around a little bit. So the first valuation that you will do is you will create a model valuation of approximately $75 a share. Got to get very close to the current trading price. That's called an as-is valuation. So we're going to take the data point of the current share price, and here's the point of intrinsic value. Our model is a cash flow intrinsic value that says if the cash flows come true, this is the price you're trading at. Well, this is the price that the company's trading at. We're going to work backwards to figure out what the cash flows are. That's the point of an as-is valuation. You work backwards from the current stock price to better understand the assumptions that drive that stock price. Okay, so here's the thing. I'm going to need to change things to get close to that stock price. So one of the things I'm going to do, you'll see this down here, legacy, is on the ratios tab, there's a forecasted share price, and then there's a broken reference. Right? And the reason why there's a broken reference is that I had actually killed the DCF tab before we recreated it last week. And what I want to do is I want to change the ratios and see what it does to my stock price. so that every time I change a ratio, I don't want to keep jumping back and forth between tabs. So what I'm going to do is I'm just going to make this a reference to the DCF, forecasted share price. Okay? So every time I make a change, the share price is adjusted. By the way, with the most recent data from CAT and everything repeating in the future, they have a negative share price, and we have to get it to 75. Okay, so we're obviously going to be changing these assumptions in just a minute. Now, let's go back to the Assumptions tab. So that's the next thing, is on this tab, I'm going to put in the current share price, and I'm going to make this yellow. And right now, the current share price is 75, what was it? 75.30. Time of the video, right? And then right here, I'm going to put in the forecast price. And I'm going to make a link to the model to either what's on the Ratios tab or what's on the DCF Forecasted Share Price tab. Try this again. Equals DCF valuation, that cell. So, and again, I'm doing this partially out of laziness, so that every time I change these things, because we're going to change these ratios a lot, I don't want to keep jumping back and forth tabs. And every time I want to change it, I want to know what the share price is. But ultimately, when we do the as-is valuation, which is what we're about to start, right, that what we want to do is we want to get to the current share price to be within $1 of the 75.30. We want to be as close to 75.30 as we can. And what assumptions would lead us to that? So, let's continue. How do we do that? Well, let's go to ratios. You can see, and it's probably easier to see on the video than it is on the projected screen, but there's three light gray tabs, or three light gray rows in this model. And if you've heard of the 80-20 rule, which is 20% of the information gives you 80% of the benefit, this is really a 10-90 rule, right? Those three numbers represent 90% of your valuation, right? It's revenue growth rate, EBITDA, which is margin, and taxes. All right, if you forecast those things, that's the majority of the work that you have to do. Now, granted, you could forecast anything with granularity, but I'm telling you, this is what the pros focus most on, and this is going to have the biggest impact. So, why does this matter? Conceptually, free cash flow. What is free cash flow? Free cash flow is gross cash flow, go to your CFI to remind ourselves, minus gross investment. Well, what drives gross cash flow? It's NOPLAT. Well, what drives NOPLAT? Well, it's going to be the revenue growth rate, your margin after tax. Hence, EBITDA margin, tax rate, and then the revenue growth rate basically gets me a forecast for NOPLAT. So it's the drivers of NOPLAT. Okay? Then, gross investment. Well, here's the other beauty of what I did on the first video, which is all of these ratios, these balance sheet ratios, are tied as a percentage of sales. So as the sales grow, the investment grows. So what we've actually set the model up to do is to assume constant productivity. So as sales grow, investment will grow. So basically the model will calculate and forecast for us the gross cash flows and the free cash flow, assuming that everything stays as a constant percentage of sales. And for most companies, productivity doesn't dramatically change over time. If my company is the exception, I could go into the balance sheet ratio and change that. But regardless, you'll find that that has less impact than the gross cash flow. And so that's what we're going to focus most of our attention on. And so the rest of the model kind of forecasts itself. So we have to forecast 6 years worth of data. That's our next step, right? And the 6 years are the first 5 years plus the first year of the continuing value, the terminal value period. Now, here's what matters. And this is very important. This is not a plug and chug exercise, right? And the way that I'm going to grade you and the TAs are going to grade you is that I know you know how to solve an equation, and I know that you're all good at math. And to be honest with you, and the people in the video can't see that, but that is nearly irrelevant to why you would be hired by a Wall Street firm, right? It's not the math. Everybody can do the math. It's the assumptions that matter. And how you put the assumptions in for the equations. That is far more important. So let's just think about revenue growth. We have to figure out what the revenue growth rate is for CAT. And what I'm telling you is if you just look at historical averages and come up with quantitative math to forecast the future, that is a terrible forecast. Right? And we already know why it's a terrible forecast, because we know that growth rates regress towards the mean over time. We know that there's a law of large number effect. So when you get bigger growing at the average rate going forward, it gets harder and harder to do. We know that market conditions will change this. We know that the things will change over time. So that's what I'm saying. That's what's more important, is understanding a view of the future than just the past as a way of predicting the future. That's the worst type of forecast that people can do. So here's the thing. I can't grade you on the future. Right? So when you're actually doing your presentations, when you're writing up your papers, whether the CAT growth rate is 2%, 4%, or 6%, I can't tell you that you're wrong if you put in any of those three numbers. But here's how you're going to be graded. How'd you come up with 2, 4, or 6%? What was your rationale? What was your thought process? What data supports that? Right? And so that is ultimately what matters. So how do we forecast revenue growth? Well, let me give you some insight. So again, I posted to Elms last October, Nicole DeBlas, who at the time was the sell-side analyst for Morgan Stanley that covered CAT and the heavy construction industry globally. We just found out in the last class that within the last week, she's gone from that position. All right, so up until last week, she was the sell-side analyst. Where she is today, not really sure. But we noticed in Bloomberg there was a change last week. But here's the point. When she came in here, she gave us a PowerPoint file, which she said, you're welcome to share with the students. So I'm sharing this file with you and anybody else. It's public data, basically. But there's a file which I posted under the CAT model folder. Under the Morgan Stanley CAT model folder, called her lecture notes. I'm giving it to you in PDF format, even though she gave me the original PowerPoint slides. So just like us, she had to figure out what is the revenue forecast for CAT on a go-forward basis. So to give you a little insight into the process, this was her presentation. And by the way, if you're interviewing on Wall Street, like, this is how it's actually done. Or if you're just really curious, like how the sell-siders work and how the research is actually done by private equity and others, it's a complete description of everything that needs to be done in here. And so I'm just telling you, if you really want to look good interviews, read this document, right? But because if they say pitch a stock, this tells you exactly how to pitch a stock in a way that they would be pitching the stocks. So here's her background, talks about what sell-siders do, talks about the team and the selection process. But here's the point. Here's how they develop a view on stocks. And this is their model, selecting the coverage universe. But the first thing they have to do, besides reading and knowing everything about a company, is eventually they're going to have to build the financial model. And part of the model is how we create a revenue forecast. So I just want to show you what they do. So one of the things that they do is, and it's explained here, but here's a highlight. They look at the macro data. They look at the economic data. They look at the industry level data. We call that EIC. That's why we're doing this, because the EIC helps you create the assumptions for your model. Now, here's how they forecast the macro model at the time for CAT. What do they look at? Well, they look at end markets as well as economic data. And here's a forecast by end market. So what does that mean? Well, CAT's a cyclical business, so they talk about the major parts of the business and where they are in the cycles. Second, for construction equipment, they talk about where CAT competes in each one of the segments globally against their peers for construction equipment, so that they're going to do a forecast by segment, by type of equipment. Then they're going to look at what are the important equipment types by market segments in different parts of the world, and what is CAT's market share and the size of those markets. Then they're going to look at global OEM earth-moving equipment. Then they're going to look at where CAT is exposed globally in the supply chain. They're going to look at how sales are highly correlated to construction spending. So they're going to look at the economic data on construction spending and those correlations over time to figure out what it's going to be in the future based on future construction spending. Then they're going to look at the U.S. market for construction, both commercial and residential, and then tie that in to where CAT is competing. Then they're going to do this worldwide. Then they're going to look at dealer inventory, because obviously if dealers have a lot of inventory, because they're in a down cycle. They're not going to buy new stuff from CAT to sell it into a down cycle. So that's going to affect the supply chain to what their sales forecast is going to be. They're going to talk about the home builder forecast. They're going to look at segment forecast. Then they're going to look at the margins of all this stuff on a go-forward basis, which means if it's based on commodities, then they're going to look at commodity prices. They're going to look at competitive prices. They're going to look historical. So when I say that we're going to forecast 3 numbers, right, this is what it takes to actually forecast those 3 numbers, right? So when the pros are doing this, if I'm a bad analyst, then I'm just saying, oh, well, the industry's growing at 3%, so CAT will grow at 3%. That's a terrible analyst, okay? And by the way, that's the standard by which you're going to work this semester. So you're going to learn how to be a bad analyst, right? But what I'm telling you, because you only have 3 weeks to do this, but what I'm telling you is when you get in the real world, what separates the good analysts from the bad analysts are the people that can support that revenue growth rate assumption with the data behind it. That makes you invaluable. That's the real value. How did I come up with that assumption? And so that's what we're going to focus on for CAT. Now, here's another thing that we can do. So at a minimum, when you do your EICs, I don't expect you in the next 30 days to do what Morgan Stanley would do. You just don't have the resources and money to invest in that. However, one thing we do have at Smith, if you go to VBIC, is we have IBIS World. And I put the IBIS World report in the CAT folder, but basically if you go to the IBIS World report for Caterpillar, which is the industry they're in, construction equipment, at least in the US, and you go to key statistics, then for any company, you'll at least see what the revenue growth rates are as percentages for the next 5 years. So as a starting point, for the companies that you just selected, you should be looking at what is the industry revenue growth. You should be looking at economic data. That's why you do EIC, by the way. Okay? So this is the process that we're going to ask you to do. So here's the next thing. I also don't expect that you have as much access or as time as the Wall Street analysts that are actually covering CAT to do these forecasts. Right? So I think that the institutions that pay attention to this for a living are probably pretty good at this. So here's the next thing. How do we take advantage of what they've already done? This is the third screen on Bloomberg that we're going to use. We have to create this financial forecast for the next 5 years. Where in Bloomberg does this financial forecast for the next 5 years currently exist that the analysts have created? That was the earnings estimate, EEO. So the third screen we're going to use in Bloomberg to help us is the EEO screen. And that's why it's so critical. Because basically this is the consensus of the people that do the work that I just showed you. Right? So that's why this is our starting point. Right? So we could think that it could be a little bit around this margin, but as a starting point, unless we really believe that we know better than the other people that do this professionally, this is where we're going to start. And here's the other thing that you'll notice, is that in the Bloomberg version of the database, even Morgan Stanley doesn't go out more than a couple of years. So they have, every one of these analysts has a forecast going out at least 5 years, but every time you put it in Bloomberg, it's publicly reported. And it's tracked so that when the data comes out and it's wrong, you look like a fool. Nobody wants to look foolish. So you'll see number of analysts. This is true in every Bloomberg screen. The first 2 years, pretty consistent. You start getting to year 3, the number of analysts that forecast drops dramatically. By year 4, people aren't willing to put their name out there in any case. So again, it's not that they don't have a forecast, but the first 2 years are the most heavily publicly forecasted that we can get. So what we're going to do is you have to forecast the next 6 years. Rather than repeating the process of just putting in random numbers, we're going to leverage Bloomberg and we're going to put in a minimum of the first 2 years. Now, if you want to use some of these analysts in 2018 and go 3 years out, you're welcome to it. But at least the first 2 years, we're going to use the consensus estimates in our model. So how do we do that? Well, the 2 numbers that matter, we're going to add to our assumptions tab. And they're right here. For the year, first year, so I'm going to make this a relative reference, 2016, and +1, 2017. We need revenue, so I'm going to call this Bloomberg revenue, and we need Bloomberg EBITDA. So this is the consensus estimate data. So again, I put the screenshot up onto Elms, but right now, the revenue forecast, is 41,357. And for 2017, 40,168. And the EBITDA forecast is 58,39. Does somebody have a Mac charger handy that I can borrow before this computer? Anybody?
I do.
Can I borrow that?
Yeah.
Thank you. I once again forgot to bring mine from home. I bought a new one after I lost it last week, and then I forgot it. It's still sitting in the box. Paid the $70 Apple tax. Thank you. Actually, no, this won't fit. This is the old one. Does somebody have the new one? It's a MacBook Pro, but it's got the Power 2 is what it's called. Thank you. You have one? Sorry for people watching on video, but Microsoft will put this to sleep. All right, please don't leave class without taking this back. And I gotta find a plug. All right, so let's see. So nobody's using this computer, so I'm gonna unplug this. Okay. Before Microsoft puts me to sleep. All right, back to our regularly scheduled programming. EBITDA for 2017 is 57.48. Now, excuse me. If I go to the ratios tab, what I need to do is I need these revenue growth rates for 2016, 2017 to get me to those revenue dollar forecasts. So percentage change. So equals current year. So I'm going to use the 2016 as the current year forecast that I'm doing. Minus previous year from the income tab. 2015 actual revenue divided by last year. So current minus previous divided by previous is percentage change. So what the analysts are forecasting is a 12% decline in cat sales for 2016. Then for 2017 equals current minus previous divided by previous. Then they're forecasting an additional 2.9% thereafter. Okay, everybody see that? I got that? Now here's a way to check this. In our income tab, I'm forecasting 41,357, and I match the consensus estimate of 41,357 by changing the ratios. The next number that I want to do is EBITDA, but here's the thing, on the ratios tab, it's done as a margin. So I'm going to make these cells not yellow. I'm going to undo the fill, because going forward, those first 2 years for revenue growth rate and EBITDA margin, I no longer want to change. I want them to be based on the entered consensus that we have put into the Bloomberg, from Bloomberg into the assumptions tab. Everybody see what I just did while I'm doing this? So I don't want to overwrite different percentages than what the consensus is doing. So I need an EBITDA margin. Well, how do I do an EBITDA margin for 2016? Equals, from the assumptions tab, the EBITDA dollar forecast for 2016 divided by the EBITDA, or the Bloomberg revenue forecast for 2016. So that, and for 2017, equals the EBITDA dollars divided by the revenue. That is my percentage forecast for 2017. Margins. Questions about how I got that number? And the third one is I need a reasonable tax rate. Here is something that I think we can look historically. And if I look at the average of the last 6 years and come up with 27%, 27% seems like a reasonable tax rate to me, but we do need a tax rate for the company going forward. right? So that one is where the past can be a guide to the future, right? But here's the point. Notice that our share price is no longer negative. Now our share price has turned positive and we're at $19.11. I'm going to save the file, and this is called the baseline. So for you to do a company, pick any other company. Let's say you were doing, I don't know, somebody here was doing what? Time Warner Cable. If I'm doing Time Warner Cable, this is what I have to do to get this model ready to go to do Time Warner Cable. Questions? Okay. All right, next step. My current share price, $75.30. My model right now is at $19.11. I need to now sync these up as close as possible, but at least within $1. Okay? So this is what's now called the as-is. I'm moving into the first one you actually have to do. So the baseline is really just the intermediate step. And most of you, as you probably work on your projects, you're not going to turn in the baseline, but you'll do this as an intermediate step to get you to the as-is. You don't have to even call it the baseline, but I'm just helping you process-wise understand how to build a repeatable model. Okay, so in this case, File, Save As. This is the CAT Spring 2016 model. This is now moving on to the as-is. Okay, so in this as-is file, our goal is to get that current share price as close as the forecast share price, as close to the current share price as we can. All right. Now, what am I going to change to do that? I'm going to start with these three things. I'm going to start with revenue growth rate. I'm going to start with EBITDA margin, and I'm going to start with tax rate. And then I'm going to look at my CVG. Those are the things that are going to matter most in setting up the as-is. Okay. So this is what I mean by plugging and chugging. All right. If I'm just plugging and chugging, I could quickly just put some numbers in there and get it to match, and I will give you a 0 on your project. Okay? I don't care how much work you did. I don't care if it took you 50 hours to do it. I'll give you a 0 on your project. You'll fail this class. All right? Because that's what this is not about. Putting in random numbers that solve an equation like an 11th grader could do that. Like, what matters is assumptions. So everything from here on out is not just a number, but it's how you got the number. You got to always articulate your assumptions because you're telling a story. And you got to give me what that story is. So here's part of the story. When I do the as-is, what I'm trying to do is I'm trying to understand the wisdom of Wall Street. Because these owners, and I'll go back to CAT, these owners, the holders, are doing similar models to what we are doing here. And they're doing intrinsic value. And what I'm telling you is that the intrinsic value is far away from the current stock price. They're going to trade to it. They're going to trade and get an arbitrage opportunity. So I at least have to know, why is the company trading at its current price, right? So directionally, I don't think CAT's going to be expected to shrink at 3% forever. I think CAT is expected to grow. I think CAT is actually expected to have higher margins. Can I say that with certainty? That CAT is expected to grow and have higher margins? And the answer is yes. Why? Why can I assume that CAT is expected to grow and have higher margins than is currently on this ratio tab in the future? How can I say that with certainty? Yeah.
Start going towards the mean.
One, they'll go towards the mean, but this is even a more simple answer than that. How else do I know that they have to do better than what's on here? What's CAT's current stock price? 75, right? What's the stock price here? 19. How do I get to 75? I got to be growing faster. I got to have slightly better margins, else I can't justify a $75 stock price on a cash basis. So I'm just telling you, this is part of the insight you start getting into the as-is. Like, CAT's not going to maintain this level of margin, and CAT's not going to maintain this level of negative growth forever. They can't. Otherwise, people would be paying a whole lot less than $75 a share. That's not the belief of the institutions. Yes?
So basically,
Even with the next 2 years, by the way, forecasted it. But go ahead.
so basically the model has to guide you towards the current.
Correct. That's the whole concept of the as-is. And what you're going to have to understand, it's not whether you agree with that. It's what the market is currently pricing the company. So that's the point. We have a data point in the real world with publicly traded companies. We're trying to work backwards to, this is a cash flow model. What are the cash flows that support that data point? And right now, the cash flows in our model, which include the first 2 years of consensus, by the way, don't support the current stock price. So therefore, years 3 going forward have to be better than what's in this model. Otherwise, you can't get to $75 a share. So that's the next point. How do we get to $75 a share? All right. So here's another thing about CAT. You can see it clearly here on, I'll just do a little chart. What do I think is going to happen to CAT's margins on a go-forward basis? I'll start with margins, because I think the tax rate's not going to be dramatically different. So what's going to happen to CAT's margins? While you're thinking about this, let me just do a quick chart. You don't have to do this. It's not going to be in their final file. But let me just insert very quickly a chart called a line chart for CAT. What do you notice about this line chart? This is the historical. Actually, here, I'll do this line chart. I'll go including the consensus. Insert chart line. Actually, I'll switch this to a bar chart. How do I switch this to a chart type? I'll make this a bar chart. Column chart, call it. There's CAT's historical margins. What do you notice? Exactly, cyclical business. So that's the point. Where do you think CAT is in the cycle right now? They're near the bottom, but slowly recovering in the next 2 years. This is the consensus. But they're not anywhere near the peak of the last cycle. So this is the other evidence that I have. This is what I was talking to you about last week. We've got a forecast across the cycle. The problem is the next 2 years, we're still in the down part of the cycle, slowly recovering. But that's the problem with CAT, is that we're going to undervalue CAT if we don't understand that this is a cyclical business that actually is going to improve over time. And so I think that CAT's margins to get to 75, that's what the market is actually doing. The professionals are saying this is a down part of the cycle, and even the next 2 years, their margins are lower than what they're probably going to be in the upside. So let's start moving towards what could they be in the upside. Yeah.
So the exercise is really what assumptions get you to justify the market.
That is exactly the exercise. That is the exact exercise we're trying to do. We're trying to back out the assumptions. And here's the key point. It's not whether I agree with those assumptions. It's trying to understand what they could be. What are the possibilities? Right? So, where did they get historically? Well, they got as high as 17%. Now, again, if I'm an analyst on Wall Street, I'm going to dig deeper into a lot more things, commodity prices, labor rates, things of that nature to build out a model. But at least here, I can at least see superficially that they got as high as 16 or 17%, and they're at 14%. So I got to start raising it. And by the way, you'll notice it didn't just go from 17 to 13 overnight. Like, I don't want to jarringly just make abrupt changes. It's kind of happening as a curve. So here's the point. Let's go from 14 to, I don't know, let's go back to the 15 and a half range. Notice our share price is closer to 32. Then let's get up to, I don't know, 16 and a half, 17, and then maybe settling closer to, I don't know, 16 and a half on a go-forward basis. And now I'm at $43 a share. Right? But here's the point. Even if I'm at 17, which is close to where they were at their peak, I'm still not at $75 a share. So what does that also infer to me? What inference can I draw? That the market must be thinking. What about revenue? What inference can I draw on the revenue? Do you think CAT's going to shrink at 3% a year? It can't be. So even if I get to these level of margins, they're not going to be shrinking forever. So they're going to eventually grow. In the U.S., they're growing at 4%, going down to 2% according to IBIS. Worldwide, China is in a mess right now. But you know what? India just overtook China as the fastest growing economy in the world. And India is doing a lot of infrastructure growth. They can't build infrastructure without CAT's equipment. And eventually China is going to recover. And the U.S. is going to recover. And that's the point. Eventually they're going to grow. And then this goes back to competitive advantage. Will CAT get more than the average company when they grow? And I think CAT does have competitive advantage along with Komatsu. And they will probably get more than the average of growth rate in the up part of the cycle. right? So again, I'm articulating my rationale for why I'm going to put in a number more than 4%. Okay, so what number might I put in? Well, let's say that 2018 looks like a boom year, so I'll call that 6%, then 8%, or how about this? 10, 8, 6, right? And by the way, during the peak cycle when they're going 10, maybe this gets to 17, and this gets to 17.5, and then they're 16. So maybe the answer is 10, I don't know, 12, 10, 8, 7. I mean, I'm playing around with the numbers, and I don't have to be exact, but here's the point of the as is that I'm doing in the video, which is slightly different than the last class, is I just want to be directionally correct to say, all right, what I know for CAT is they're probably looking at mid to high single digits minimum growth rates, and they're looking at better margins than where they are in the next 2 years forecast to justify a $75 stock price. Somewhere between slightly lower growth and slightly higher margin, or slightly higher margin, slightly lower growth, but I'm kind of in the ballpark of understanding what's driving the current stock price for CAT. Questions about how I did this? Because you're doing this as a homework. This is your next homework assignment, by the way. So questions about this? Yes?
Your assumptions have to be correct year per year or over the period.
They have to be explainable.
Explain the year per year.
Because that's what I'm telling you. Everything I'm putting in here, well, one, I'm being a bad analyst. I'm quickly making this up. But two, notice I'm at least explaining why I'm putting what I'm putting in here. So that's what I'm saying. None of us can tell you what's going to happen in 2018, 19, 20 to the world, much less CAT. But at least I can explain to me why am I using 10 to 12% and why am I using 8%. And part of the reason why I'm using 12% is I go back in the historical part of the cycle and I see big jumps and big drops. All right, I'm smoothing out a little bit over what they've done historically, but regardless, and so I'd have to probably refine this upon doing some more work. And that's the other idea. Is in this class, it's perfectly acceptable to read the analyst reports and read the forecast and replicate the forecast. Just don't plagiarize. But this is all a real world exercise, so you definitely want to recreate that. All right. So by the way, we now have the file called the as is. Final step, we want to create the target share price. This creates our buy, sell, hold. So I'm going to rename this file, save as, and let's see. I'm going to call this the target video. So the difference between the as is and the target is with the as is, we take the current stock price and we work backwards. With the target, we put in what we believe the assumption should be, and we create a stock price, which could be different than the current one. And then the buy, sell, hold is the difference between the two. So when we adjust the model, if I think, you know what, revenue growth is going to be 0 going forward, even at better margins, sell. Sell, sell, sell. All right? So that's the point. Current price is 75, my target price is 50, get out. Get out now before people wake up and realize this is a bad deal. If I think the CAT's going to grow at 15% a year, buy as many shares as you can because CAT is worth $100 and I want to get in now while it's cheap. Buy. And if I think that it's fairly priced, hold. Here's the math. Most analysts use 10 to 15% as a trading range. We're going to use 10%. All right, so that means if I'm within 10% of the current stock price, it's a hold. It's just a trading range. So if CAT goes from 75 to 78, I'm not going to say suddenly sell it. It's just a trading range. Now, if CAT, I really think, is worth more than $7.50 to 75, so I think it's worth 83 or more, then I'm going to put it in the buy category. And if intrinsically I think it's worth 65 or less, I'm going to put it in the sell category. So plus or minus 10% is your range, and you have to come up with the scenarios. And then here's the final best practice. Go back to Morgan Stanley. What the better firms do is when they come up with their share price, they articulate a range. And you can see it on here. So at the time, CAT was at 70, and they said in the bull case, They could go as high as 91. In the bear case, they could go as low as 29. And our target is actually 70. So when Nicole, who was a hold, thought that CAT was fairly valued last October at close to 70. But she also articulates, and this is what we're going to have to do, if things go a lot better than people expect, including my own assumptions, they could be worth as much as 91, and they could be worth as little as 29. So when you're talking to the institutions, you don't just want to give one number. You want to talk in terms of ranges and confidence intervals. And you want to articulate your assumptions and what happens if your assumptions are wrong, and how wrong could they be, and what's the directionality. So this is why when you do your target share price, you're going to turn in 3 files. You're going to turn in a bull case. What is the bull case? What are the assumptions for the bull case? And you're going to have an Excel model that represents the bull case. What is your bear case? What are the assumptions for the bear case, and what are the assumptions that would cause it to be a bear case? And then where do you end up? Because you got the current price, you got the bull, you got the bear. What's your final opinion? So I got a range, and then this is where I think it's going to be. Maybe I think the bull case is where it's going to be, not the bear case, and so therefore I'm more on the bull side, and I think it's worth a lot more, and it's a buy. Maybe I think the bear's right, and now's the time to get out, or maybe I think the hold is right. Why? Everything has a why attached to it. Questions? All right, so here's what we're going to do. So this is where I ended the last class, so I'm going to end at the same place with you. And by the way, I'm going to upload, because this is synced to the video, this file with this as is, which was slightly different than the as is during the 11 a.m. section. I'm going to put it in the CAT folder. Okay? So this file is there. At the beginning of class on Wednesday, I want you to tell me what your target price is. You're not going to turn in 3 files, and it's not even a graded homework assignment. But look at the file, and just at the beginning of class, we're going to solve this, and we're going to say, where do we think CAT should be? And we're going to create that target price. And why? What are the assumptions that create the target price and why it's going to be? Then, during Wednesday's class, I'm going to give you, right after we do that, another company. It'll be in a completely different industry. And we're going to go through the entire process for that company during Wednesday's class. Then, at the end of Wednesday's class, actually the end of the day Wednesday, I'm going to give you yet another company in a completely different industry, and that is homework 8. So for homework 8, which is due 1 week from today, you're going to have to turn in 4 Excel files and do a complete write-up explaining all of your rationale and assumptions that go along with those 4 files. So that is your next individual graded homework assignment that is due 1 week from today, based on what happens end of day class on Wednesday. All right? And by the way, that is what you're going to have 2.5 minutes to communicate in your group project, approximately. Assuming a 10-minute PowerPoint presentation, and you're probably going to write up 3 to 4 pages as well as turning in the files. So this is practice for the group project. And by the way, next week you'll have 2 more companies doing the same thing, more homework assignments. And then we'll include multiples, because here's the other thing. I can't tell you this now because you don't have enough information, but I'll give you some other insight. Hiding in the multiples are some additional assumptions that will help us validate how to actually do this. So the multiples actually give us information about the types of assumptions that we're trying to make here, and that's what we're going to talk about, how to pull that information out next week and make this even more refined. So we'll iterate. Right? So otherwise, that's the end of class today. I'm going to save this on YouTube, and I'll see everybody on Wednesday. Ready to go.